TSX has been in rally mode. It's currently sitting at a 5-month high. Our next guest says there could be some lumps along the way, but any weakness should be viewed as buying opportunities. Let's bring in Rob Lauzon. He's Managing Director and Chief Investment Officer at Middlefield Capital. Thanks so much for being with us. I want to talk just a little bit on the rally that we have seen, because it's been surprising in the face of, pretty dark clouds that seem to be still brewing, recession fears, whatever's happening with China, oil pulling back, and yet we see equity resilience. How do you explain that?
Yeah, a lot of it is a little bit of seasonals and a lot of technicals. There was a lot of put buying, so there's a lot of hedging for worst case scenarios, especially when electricity prices and natural gas prices in Europe were all-time highs maybe 3 months ago. So that forced a lot of hedging, which then needed to be unwound when gas prices have come down. They've got full storage for this winter, and electricity prices have come down. So I think that was a big part of it, which then causes these big fund flows of money to have to get long equities again. And at the same time, we started seeing pockets of disinflation in the summer. Everyone shrugged it off, but now it's starting to express itself into the numbers, and you've seen it in yields come down.
Yeah.
And as soon as yields started coming down, that's generally obviously positive for equities, lower cost of capital, and that's what we've seen. So that's really kind of telling the story here. And then the last 3 weeks has really been seasonal. Typically, we had the midterm elections, and having a bit of gridlock is always good, because you can't get too much done on the far right or the far left. So that's good for equities. And U.S. Thanksgiving. I read a stat this week. Years when the market's down over 10%, which is this year, typically the Tuesday, Wednesday before the Tuesday is like 2-3% up. So I think this might be, we're in the final act of this rally, and I'm confident in that just from a valuation standpoint. So 40, 50 on the S&P, which is where the futures are right now, indicating is about the 200-day moving average. And on 220 earnings next year for the S&P, that's like 18.5 times earning multiple, which is pretty fair when rates are not 1 or 2% anymore. So I think investors should embrace that they've clawed back some of their losses here. But I'm worried, and we can get into this, I'm worried a little bit about management teams coming clean, giving 23 guidance when they get back in the new year. Whether some of them might do it post-Thanksgiving, many might do it in Q1. And that'll reset earnings.
Okay, so let's talk about that. That will, create perhaps another lower for the market, but it sounds like you're looking forward to that. You'd like that for a buying opportunity.
Yeah, because I really like how that will set us up for 24.
Okay.
So that's getting far out. But remember, the stock market always looks 6 months in advance. So this will all happen in the first half of next year. Pepsi, lots of companies have been able to push prices higher. Maybe we're still able to buy $5 Dorito bags, but $8, and then there's 2 chips in there. There's a point where it doesn't work anymore. So I think the revenue line for pushing price increases through to the consumer or the business, whoever the end buyer is, we're at the end of that. And at the same time, costs have been sticky. Costs are still going up. Wage inflation is still there. So you're going to get margins squeezed, and that will be what is used as the reason for companies to guide down earnings estimates for 23. Once they come clean with that, then we get another reset in the market. At the same time, if rates continue to come down, maybe we just retest those lows of 35, 3,600 we found this year. That's probably the 220 number. If it's worse and some other exogenous events happen, China, COVID lockdowns continue versus get better, perhaps the war somehow gets worse, or just there's more oil and grain shocks next year, that could make a deeper recession, and I would get more bearish. Right now, I'm in the category of be cautious right now. Buy that dip that I'm that I'm forecasting 5-10%, maybe 15% in the market early next year. 3,500, buy that, because now we have a good reset for what we see in 24.
Okay, so let's talk about what could be on your shopping list. In a former life, you were a big energy guy, and then you kind of pivoted when that just was not a great place
Right.
to be. Have you gone back? Have you had a reunion with your old pals in the energy sector?
And that was a function of price, right?
Yes,
If it's $40 oil and $2 gas, I don't need to be in that sector.
Yeah.
We pivoted back slowly last year and then early this year. And in fact, some of our diversified funds are up on the year. So we've outperformed by like 20% on some of our diversified funds that went more into energy infrastructure and into the producers. So, we're sector agnostic. We'll go where the money is. And in 24, if tech is the place to be, I'll be back 25% tech in some of our diversified funds. So we like energy. It still represents good value. $70 oil, I think, is the floor. $4 or $5 gas floor, that is still going to represent a pretty good place to invest for 23 for energy, both on the pipelines and in the producers.
Well, you mentioned tech. Do you think it has a place in your portfolio? It's such a large place, 25%.
Well, it's slowly, that was the market weight. I think it's closer to 20 or even 18% now, depending if you're using. There's that. They moved a lot of the tech names into communications.
Yes, I don't like that.
But
because then they trade with cable companies. That doesn't make any sense.
Right.
But anyway.
Yeah, but I think tech is an important part of how we will fight inflation, and it's automation. It's productivity, right? So we do need software companies. So the software companies that we'll continue to look at and continue to own from time to time, the Adobes, the Microsofts, ServiceNow, those type of companies have a place and will be viable companies. It's just what price do you pay when, businesses might stop spending at the rate they have been on tech for the next couple quarters. So that's still an area that we're not over our skis in yet, but that could be more intriguing next year. We own some, but it's not overweight by any means.
So before I let you go, AltaGas in the energy sector, I want to get this one in CAPREIT, Canadian Apartment REIT.
Yeah.
That's an interesting sector because there has been this premium on dividends, and yet the REIT sector as a group has not done very well, and then there was a bit of M&A that kind of supported things. What do you like in CAP specifically?
Well, CAPREIT is apartments, and early November, the feds announced even a more accelerated immigration policy. So we might get 1.5 million people over the next 3-4 years coming to Canada. Some will go to Calgary, some will go to Winnipeg, come to Toronto, some will go to London, Ontario. But that's very positive for demand for rentals. And when you immigrate here, you're probably not going to get a mortgage right away to buy a house. It might take 2 years to get a job, show the bank that you've got employment. So demand for rentals is there. And this stock is down. All REITs got hit because of the interest rates went up. REITs get hit quickly. And then now they're adjusting to a higher interest rate environment. So CAPREIT trades at 20%, 25% discount to its NAV. Oh, wow. And you've got good demand for their buildings. They're full. And what's happening within CAPREITs from a micro level, management is selling off non-core apartment buildings at NAV and buying back stock at a 25. So it's in theory, if they did that forever for the next 10 years, they would privatize this company one day at a time, and the stock would go from $43 to $60 where their NAV is. So that's one of my favorite ideas right now. And I think it's a pretty good risk reward at this level. I'm pretty confident, you got a 3-4% dividend plus probably 20% upside next year in that story. So that's one of our favorite defensive plays. All
right, Rob, thanks so much. That's good perspective. That's Rob Lauzon, Managing Director and Chief Investment Officer at Middlefield Capital.